The signal hasn't flashed red like this since 2007.
Look at the numbers. We are currently staring at a stock market valued at 201% of the entire United States gross domestic product.
The last time valuations detached from reality this violently, trillions of dollars in wealth evaporated in weeks.
The media is telling you to buy the AI hype.
But behind closed doors, the smart money is doing something very different. They aren't buying. They are running for the exit.
Today, we expose the data the insiders are watching and exactly how to position your portfolio before the music stops. Let us analyze the current reality with brutal honesty. The stock prices of these technological titans have experienced a surge that can only be described as unprecedented. The order books are full, and the momentum seems unstoppable.
Yet, in the face of this staggering success,
Why would the leaders of the new economy retreat when they are seemingly winning? Because the history of finance teaches us a critical, often painful lesson: the moment to be most vigilant. Today, here at Capivestor, we are going to dissect the data that the insiders are watching.
this analysis is not designed to create panic, nor is it a crystal ball claiming to predict the future with absolute certainty. This is an exercise in elite pattern recognition, honed through 30 years of navigating technology supercycles. And the patterns flashing across the terminal today bear a haunting resemblance to the calm before the storm of previous major market adjustments.
Visit Capivestor.com for exclusive insights. Protect your portfolio. Stay informed. We must begin by dissecting the valuations. Currently, the stock market is arguably more inflated than at almost any other time. We look at the price-to-earnings ratio of the S&P 500, an index composed of the 500 largest publicly traded. Today, that ratio sits above 30. To understand the gravity of that number, you must understand the context.
This means that for every dollar of profit a company generates, investors are currently paying nearly double the historical norm.
This is not a minor statistical deviation or a slight overvaluation. This represents a market that has fundamentally detached. But the data gets darker. There is a macroeconomic indicator that the Oracle of Omaha. It is known as the Buffett Indicator, and its calculation is deceptively simple, yet profoundly telling. As we speak, this indicator sits at a staggering 201%. Let that sink in. The paper value of the stock market is worth more than double the actual economic output of the country it represents. This is the highest level ever recorded, surpassing the peaks seen before the dot-com bubble burst, and even the heights reached before. Now, the counter-argument is always the same. Investors will say, but this time is different. AI is a paradigm shift. These valuations are justified by exponential future growth.
And while the long-term potential of artificial intelligence is undeniable, believing in the technology does not grant investors a license to ignore the iron laws of market fundamentals.
It does not mean we can disregard basic valuation principles.
Nor does it mean that economic gravity has ceased to exist. The market is a complex ecosystem, and while innovation is key, fundamentals always catch up.
The question remains, How long can this divergence continue? We must understand the anatomy of a technology cycle to see where we truly stand.
Every major industrial revolution follows a specific, repeatable trajectory.
First, we have the breakthrough. The core technology is invented.
Second, we enter the hype phase. Excitement builds, capital floods into the sector.
During this phase, companies with zero revenue and broken business models receive billions in funding. Then, inevitably, comes the crash. Reality reasserts itself, the weak are culled, and valuations plummet to earth. Only then, after the fire, does the true value creation phase begin, where the survivors build the future.
We watched this script play out with the railroad mania of the 1800s. We saw it with the radio and automobile explosions of the 1920s. We lived through it with the internet in the late 1990s.
And make no mistake, we are watching the exact same movie play out again with artificial intelligence.
The technology is real, and the potential is immense. However, that reality does not guarantee success for every equity in your portfolio.
Nor does it justify paying 200% of GDP for the market. A painful correction is historically the mathematical outcome before we reach the phase of sustainable value. We are currently deep in the hype phase, and the symptoms of mania are everywhere.
The parallels to the dot-com era are striking and terrifying.
But as we will reveal shortly, there is a hidden mechanism in the bond market that suggests the clock on this mania is running out faster than anyone realizes.
What concerns us most at Capivestor is that this overvaluation is not contained within a single sector.
It is systemic. And when you combine stratospheric valuations with the pressure of rising interest rates, you create the perfect conditions for a financial superstorm.
Here is the uncomfortable truth. For 40 years, from 1981 to 2031, investors played the game on easy mode.
Interest rates were near zero. Money was free. When money is free, asset prices float into the stratosphere because there is no gravity holding them down.
But the regime has changed. The Federal Reserve has turned gravity back on.
We have moved from 0% to over 5% in a heartbeat. This is a mathematical anchor on every stock in your portfolio.
You cannot have record-high valuations in a world of high-cost capital. Something has to break.
And history tells us it won't be the Fed that blinks first. It will be the stock market.
Either interest rates must collapse, requiring the Federal Reserve to cut aggressively, usually a response to a recession,
or asset prices must adjust downward to reflect the higher cost of capital. The smart money is positioning for the latter.
Let's zoom into the engine room of the technology industry. This is where the capital expenditure is happening. The spending on AI infrastructure has been nothing short of immense. The hyperscalers, Microsoft Azure, Amazon.
On the surface, this looks like a boom. Revenue is growing, margins are fat, and backlogs are extending into the future.
But the question every sophisticated investor must ask is this: is this spending sustainable?
Or are they spending out of existential fear? Are they burning cash because they have a clear path to profit? Evidence is mounting that it is the fear of missing out, rather than the promise of profit, driving this cycle. This is the field of dreams fallacy. Build it, and they will come.
Companies are racing to deploy capacity without a clear monetization strategy. This mirrors the fiber optic boom of the late 90s, where billions were spent laying cable that wouldn't be utilized for a decade.
The technology was real, but the capital was incinerated.
We may well see a period of significant spending pullback, a phenomenon known in the industry as digestion.
We are already seeing the cracks.
Executives are beginning to ask tougher questions about efficiency. Timelines are being pushed back. Budgets are being scrutinized. These are the subtle tremors that precede the earthquake. This is the transition from the hype phase to the reality phase.
Now, we must discuss the doomsday metric, the yield curve.
For those uninitiated in macroeconomics, the yield curve charts the relationship between short-term and long-term interest rates.
However, occasionally, the curve inverts. Short-term rates become higher than long-term rates. Historically,
The curve inverted deeply in 2022 and 2023, signaling a crisis.
But here is the trap that catches 90% of investors. The crash rarely happens when the curve is inverted. It happens when the curve snaps back to normal. We are in that normalization period right now. The un-inversion is the trigger event. Skeptics will point to the current data and say, the economy is robust, employment is holding, GDP is positive. Where is this recession?
they are correct that traditional metrics look stable, but market history teaches us that crashes do not occur when things look bad.
Markets crash when complacency is at its peak. Recall the first half of 2007. The S&P 500 was hitting all-time highs. Real estate was booming. The consumer was confident. Then, the cracks appeared in the subprime mortgage bonds. Bear Stearns collapsed. And within a year, the global financial system was on the brink of total failure. Or look at early 2000. Tech stocks were minting millionaires by the hour.
Then the Nasdaq lost 78% of its value, wiping out trillions of dollars in wealth. We are not guaranteeing a collapse of that specific magnitude, but we are asserting that the ingredients for a major correction are in the pot. Historic valuations, rising cost of capital, a normalizing yield curve, and market breadth concentrated in just a handful of stocks.
So, how does one survive this? What is the wealth management strategy for this environment? We have analyzed the actions of the most disciplined capital allocators, and their strategy can be broken down into specific, actionable steps. First, they are building a fortress of cash. Operating cash flow is being hoarded. Instead of mindless stock buybacks or overpriced acquisitions, the elite are maintaining larger-than-average cash balances. Cash is not just a safety net, it is an offensive weapon. It provides optionality.
When the market corrects and prices dislocate, the investor with cash becomes the king, able to acquire distressed assets for pennies on the dollar.
In 2008, those with liquidity bought empires. Those with leverage faced bankruptcy.
Second, capital allocation has become ruthless. The days of growth at any cost are over. Every expenditure is being scrutinized against the new cost of capital. This is a shift from the 2021 mindset, where money was free. Today, discipline is the only shield against the higher rate environment. Third, they are prioritizing portfolio diversification. The concentration risk in today's market is terrifying.
If your portfolio is dependent on the spending habits of 4 or 5 hyperscalers, you are exposed to a single point of failure. Smart allocators are broadening their exposure to sectors like healthcare, consumer staples, and industrial automation.
Sectors that will use AI to improve efficiency, but are not solely dependent on the infrastructure build-out to survive.
Fourth, they are managing expectations. The narrative of beat and raise cannot last forever. Prudent leaders are now providing conservative guidance.
explicitly highlighting risks. They are preparing the market for a slowdown so that when it happens, the shock is dampened.
Fifth, there is a massive pivot to efficiency. Companies are using AI internally not to sell it, but to fix their own operations.
They are automating workflows and optimizing supply chains to drive operating leverage.
The goal is to do more with less. If revenue growth stalls, a lean cost structure allows a company to make. Sixth, they are engaging in deep scenario planning. They are wargaming the downturn.
What happens if revenue drops 20%? What happens if rates stay at 5% for 3 more years? By preparing responses to these scenarios in advance, they eliminate the need to make panic decisions in the heat of the crisis. Flexibility and preparation are infinitely more valuable than prediction.
Seventh, communication has shifted. Leaders are being transparent about the economic winter. This isn't to incite panic, but to sharpen focus. In boom times, culture can become lax. In uncertain times, execution must be flawless.
We must also address the specific dynamics of the AI market itself. The demand for compute.
But this demand curve will not be a straight line up. We are approaching a digestion phase.
It is inference phase, aptly complex.
Furthermore, competition is arriving. The monopoly of a single chip designer is eroding. AMD, Intel, and the custom silicon labs of Google and Amazon are bringing alternatives to market.
This introduces pricing pressure. While competition is healthy, it compresses margins and changes the growth calculus.
Add to this the geopolitical minefield, export controls, trade wars, and the bifurcation of the global.
We must dispel the myth that revolutionary technology prevents market crashes.
The internet was the most revolutionary technology of the 20th century. It changed human civilization.
Yet, the crash of 2000 still happened. Amazon, the king of e-commerce, saw its stock drop over 90%. The technology was real. The valuation was not. I will likely follow this same path.
The correction, when it arrives, will be the mechanism that separates the legitimate businesses from the paper tigers. The smart money is not trying to time the exact top. They are building resilience.
They are positioning themselves to survive a storm and thrive in the aftermath.
This stands in stark contrast to the retail investor who is all in, leveraged to the hilt, and betting on a permanent bull market. Even in the darkest times, maintaining unwavering faith in one's capabilities is paramount.
We look back to the late 1980s, where companies faced near bankruptcy, fighting for survival as competitors vanished.
Those who survived did so not by watching the stock price, but by relentlessly investing in their core vision, even when the market declared it worthless.
The storm is coming. The only question is, will you be a victim of the crash or